A lawsuit filed by the cryptocurrency exchange Celsius Network claims that Prime Trust cancelled its relationship with the company in June 2021 due to red flags. The lawsuit states that the company was unable to pay back customers, even after they had invested a substantial amount of money in the exchange. Prime Trust did not respond to requests for comment. The company claims that it is still in the process of restructuring its debt. According to the lawsuit, the crypto exchange failed to cover its payouts after it was hit by severe exchange rate losses. The company has a history of bad behavior and has been sued by former money manager Jason Stone. The former manager claims that Celsius is a Ponzi scheme and has cheated him out of hundreds of millions of dollars. The company did not respond to a request for comment about the complaint. The company's CEO, Roche, declined to comment on the complaint. The lawsuit also alleges that the company misappropriated customer funds by investing them in risky trading strategies. In addition to investing customer funds, Celsius transferred hundreds of millions of dollars to Stone's company. Stone was then given private cryptographic keys to the funds. Stone was also required to invest through DeFi, a constellation of apps aimed at reducing centralized banking and facilitating decentralized finance. According to the lawsuit, Celsius engaged in illegal activities to artificially inflate the price of its own digital coin, CEL. The company also failed to hedge its risks by implementing basic risk management strategies. As a result, Celsius's liability to depositors in Ether far exceeded its holdings in Ether. This forced Celsius to buy more Ether in the open market at exorbitant prices. Furthermore, when customers tried to withdraw their deposits, the company suffered heavy losses. Celsius also made offers of double-digit interest rates to entice new depositors, which were used to repay earlier depositors. In a lawsuit filed by a former employee, the company is seeking the return of the $17 million it borrowed to invest in cryptocurrency. The lawsuit alleges that the CEO knowingly mishandled customer funds to manipulate the price of the cryptocurrency. This led to the company losing hundreds of millions of dollars. The company also failed to hedge its risk, and it has no liquidity buffer for a sudden downturn. Its assets are worth $20 billion, and the company offered 18% interest to its customers. A lawsuit filed by cryptocurrency lender Celsius against its former infrastructure provider, Prime Trust, for $17 million in lost profits is the latest example of how cryptocurrency investors may be victims of fraud. The company has reportedly been guilty of defrauding consumers by offering interest on crypto holdings and loans, while using those assets to artificially raise the price of its own coin. Furthermore, Celsius failed to properly account for payments to its users and used these payments to lure new crypto holders into its business model. The lawsuit also alleges that Celsius was operating a Ponzi scheme, using customers' deposits to pay for early investments. Critics have long compared the crypto market to a Ponzi scheme, in which a scammer uses new investors' money to pay off earlier ones. In the case of Celsius, Stone claims that the company used its customers' deposits to manipulate the market by transferring valuable non-fungible tokens to his wife's wallet, a move that he said resulted in fraudulent conduct. The suit has a number of other flaws. The company's borrowers are largely anonymous, making it difficult to determine exactly who they are and whether they borrowed from Celsius. In fact, few of them have acknowledged they borrowed from Celsius. The unclear terms of these loans have also made it difficult to collect debts. As a result, the lawsuit has prompted several inquiries and investigations by state and federal regulators. In addition, the company's creditors have set up a special committee to investigate these issues. As a result, the suit alleges that the company failed to properly hedge its trading risks. By failing to keep its Ethereum holdings equivalent to its liabilities, Celsius was forced to purchase a larger amount of Ether in the open market. This caused Celsius to suffer massive losses when its customers sought to withdraw their deposits. In addition, the lawsuit alleges that Celsius used double-digit interest rates to lure new depositors. The company also used the money to repay deposits made earlier by its customers. As a result, Celsius's business model has been severely damaged. The company was forced to cease offering its services in the state of New Jersey. Meanwhile, the Texas State Securities Board filed a notice of hearing in February regarding a similar move to halt Celsius's operations in the state. The two moves are part of a broader regulatory crackdown on crypto lending platforms in the US. Previously, 5 states filed similar orders against BlockFi's competitor, based in New Jersey. The company has also made some significant announcements. It has added Apple Pay as an option to make payments for digital assets. It also announced that it has more than $1 billion in assets under management. It also announced that it has reached 1 million users. In addition, it also announced that it had raised $15 million in a funding round. In addition, it has added support for Avalanche, AVAX, to its interest-earning platform. According to Bloomberg, cryptocurrency lender Celsius is suing infrastructure provider Prime Trust for $17 million in escrow fees. The two companies had a contract to provide services in New York and Washington. However, the relationship ended in June 2021. Prime Trust refused to transfer 398 BTC, 196,268 CEL tokens, 3,740 ETH and 2.2 million USDC to Celsius. After a lengthy process, the US trustee will decide whether or not the company is owed any money. The trustee will be able to make a decision based on the findings of the independent examiner. Prime Trust says Celsius has used its services for the past 4 years, but the company has been spending $17 million in the last 2 months. The money was spent on setting up a mining site. But the company has since taken it back, citing regulatory uncertainty and moving operations to the US.